If you're over 60 and you've been driving for decades without a single major accident, you might assume your insurance company sees you as a reliable customer. You might assume your rates are stable. You might even assume that your long, clean record actually counts for something. You'd be wrong. And in 2026, that mistake could cost you thousands. Insurance companies have quietly rolled out a new generation of pricing algorithms, and these systems don't care about your 20 years of clean driving. They're looking at something else entirely. They're looking at your age, your reaction data, your cognitive patterns. And right now, across the country, senior drivers are opening renewal letters and finding rate increases they never saw coming, with no real explanation, no warning, and no easy way to fight back. Today, we're going to pull back the curtain on exactly how this is happening, what triggers these spikes, and most importantly, what specific leverage you have to push back. Let's start with the algorithm problem, because this is where everything begins. Traditional insurance pricing was relatively straightforward. Your driving record, your vehicle type, your location, your claims history. These were the inputs. But starting around 2023 and accelerating aggressively into 2025 and 2026, major insurers began integrating telematics data and what they call cognitive risk benchmarking into their actuarial models. What does that mean in plain language? It means your car is now a data collection device, and your age is being used as a risk multiplier in ways the industry has never been this explicit about before. Telematics works through a small device plugged into your vehicle's OBD2 port, or through your car's built-in connected system if it's a newer model. This device tracks your hard braking events, your acceleration patterns, the times of day you drive, your cornering speed, even how long your reaction window is before you apply the brakes. For younger drivers, these programs are often marketed as savings opportunities. For seniors, they frequently function as rate increase generators. The same data point that reads as cautious driving in a 35-year-old gets flagged as delayed reaction time in a 72-year-old, because the algorithm is filtering that data through an age lens. Here's the part most people don't realize. You may have agreed to this data collection without knowing it. If you accepted a safe driver discount program anytime in the last 5 years, you likely opted into continuous telematics monitoring. Read your current policy documents carefully. Look for terms like usage-based insurance, connected car data, driving behavior monitoring, or references to any branded program like Snapshot, Drive Easy, or Right Track. If you see any of these, your driving behavior is being scored in real time, and that score feeds directly into your next renewal rate. Now let's talk about cognitive assessment benchmarks, because this is the part that should concern you the most. Several large insurers have begun incorporating anonymized data from DMV medical review files, prescription drug databases accessed through data broker partnerships, and in some states, results from voluntary cognitive screening programs into their risk models. The legal landscape around this is murky, which is exactly why companies are moving quickly. In states where age alone cannot be the explicit basis for a rate increase, these cognitive proxies are being used instead. The algorithm doesn't say you're older so you pay more. It says your profile matches a risk cluster that statistically correlates with increased claims. The output is the same. The liability is distributed. So what specifically triggers these sudden premium spikes? There are several mechanisms, and knowing them is the first step to fighting them. The first is the age band reclassification. Most insurers use internal age tiers, and when you cross into a new tier, your base rate recalculates automatically. Common trigger points are 65, 70, and 75. You don't have to do anything wrong. You simply have a birthday, and the algorithm reclassifies your risk profile. The second trigger is telematics score degradation. If your connected driving data shows any combination of increased braking intensity, reduced nighttime driving, or shorter trip distances, the system may interpret this as functional decline rather than smart, conservative driving. A senior who wisely avoids driving after dark and stays close to home is being penalized for exactly the kind of behavior that should reduce their risk profile. The third trigger is what the industry calls claims adjacency flagging. If anyone in your zip code or demographic band has filed increased claims in a given period, your rate can increase even though you personally filed nothing. This is the actuarial spreading of risk, and it hits concentrated senior communities disproportionately hard. The fourth is the soft renewal trap. This is a deliberate business practice. Insurers will send renewal notices with modest increases, counting on the fact that most customers won't scrutinize a 15 or 20% jump closely enough to challenge it. When that happens across 3 or 4 renewal cycles, you've experienced a 40 to 60% effective rate increase with no single moment triggering outrage. So what can you actually do? First, request your complete loss run report. You are legally entitled to this document. It shows every claim associated with your policy going back typically 5 to 7 years. Review it carefully. Errors in loss run reports are common, and a single incorrectly attributed claim can inflate your risk classification significantly. Second, request a formal explanation of your rate calculation. In most states, insurers are required by law to provide this upon request. Ask specifically which rating factors increased, by what percentage, and under which actuarial category they were filed. When companies know you understand how to read this documentation, the conversation changes. Third, opt out of telematics if you haven't already. Some states mandate an opt-out right even if you previously enrolled. Check your state's Department of Insurance website and file a formal opt-out request in writing. This creates a paper trail. Fourth, shop aggressively and use that competition as leverage. Get quotes from at least 3 competing insurers before your renewal date. Then call your current insurer's retention department, not the general service line, the retention department, and tell them specifically which competing offers you have. Retention teams have pricing authority that standard service representatives do not. Fifth, consider working with an independent insurance broker rather than a captive agent. Independent brokers have access to multiple carriers and a financial incentive to find you better pricing. They also understand the internal rate structures in ways that give you a significant negotiating advantage. Sixth, if you believe age-based discrimination is occurring, file a complaint with your state's Department of Insurance. Document everything in writing. Regulators in several states are actively investigating algorithmic pricing disparities affecting senior drivers right now, and your complaint adds to a body of evidence that creates real regulatory pressure. The bottom line here is this. The insurance industry is running an information asymmetry play against senior drivers. They understand their algorithm. They're counting on you not understanding it. Every piece of knowledge you bring into that renewal conversation is leverage. You earned your driving record over decades. Don't let a pricing model erase it quietly. If this information gave you something actionable, share this video with someone who needs it. And drop in the comments what state you're in. We're tracking where these practices are most aggressive, and that information helps everyone watching.